For more on today's inflation read, what it means for the Fed, and when or if we will see cuts, let's bring in Wells Fargo senior economist Michael Pugliese. It's good to see you.
Thanks for having me, Joe.
Welcome. Yeah. You were listening. Who is everyone FOS or does anyone know anything?
Yeah, the inflation discussion to me is one where it's either a glass half full or a glass half empty. Right? If you're an optimist, the way I look at the inflation outlook right now is take core CPI as an example. It's at 3.6% year over year. That's the lowest we've been at in 3 years. Right? We're moving lower, slowly but surely, grinding to a much more kind of normal inflation environment. A little more pessimistic, kind of your side of things, Joe. 3.6% is still really high.
37 months above 3%.
Exactly. To give you kind of some scale for that, 2.4% was the high in the 2010s on core CPI. So you're still 100 basis points above the highest we saw over that entire decade. But again, down from 7, 8, 9 and moving in the right direction, I absolutely think is the case.
We didn't know it was moving in the right direction until today.
That's fair. Had three bad prints in a row.
Yeah.
Took the Fed out of the play.
And so this is for sure. This is for sure. But I mean, markets look like it today.
Yeah.
And if if the 2 years the only Fed guy you listen to, I mean, then
Mr. 2 year.
Yeah, Mr. 2 year. So how many this year?
I think 2. I think 3. I'm a little skeptical we'll get to 3. I'd probably bet on 1 before 3, but I do think they'll go this year. If we keep grinding lower like this, we were at about 4% at the end of last year. You're at 3.6 today. I think if you can get kind of the low to mid 3s on core CPI, mid 2s, high 2s on core PCE, I do think they'll go. It'll be slow. It'll be gradual. I don't expect it to be a really strong pace of easing like we've seen in the past, but 1 or 2 cuts this year I think is very realistic.
1 or 2 cuts is a lot different than higher for longer or an increase. And there's people around, with Druckenmiller was on last 10 days ago or so, said that this was a fumble at the 5-yard line and we're going to end up having to come back and revisit inflation that stays too high.
Yeah, and particularly if we get a shock, right? I mean, I think that's what the Fed really worries about is, sure, we're on this trajectory, but it's been upset before. Omicron wave, and you saw Russia invade Ukraine, and fiscal stimulus that comes out of nowhere from Congress and other the policymakers in D.C. And that, I think, is the worry for them is, sure, everything else equal, they're on a good trajectory, but it just takes one more shock to set them back yet again like we've had the past
Someone
few
today
years.
said Powell's worried about something breaking, even right now. And once again, I couldn't figure out why he is just so dead set on,
But that's not their policy. Their policy isn't to judge what's going to break. Their policy is basically...
Well, why else would he be so dead set on cutting, Tim? And he's been, even when he shouldn't be and gets numbers where he shouldn't, he says, well, we're closer. We're not going to do it now, but we're closer. He didn't know if we were closer. Well, maybe he did now after today.
You're right. And back to Michael, I mean, why do you have to cut? I mean, if this is a data-dependent Fed, this is a Fed that's not worried about the long lag effects of monetary policy. If they did, they wouldn't be the Fed. That's not. They're not traders. So what is it about the macro right now that says they have to cut? We're at full employment. Jobless claims tomorrow, or Friday, tomorrow, are starting to become this volatile series that, if you want to, again, be half empty, you can say, hey, look, it's starting to break. But I guess just explain to me why we have to go. Yeah. I mean, you seem pretty matter of fact about 2.
Yeah.
Yeah, I mean, the way I kind of think about do they have to go is 2 things. One, we look across past cycles, you don't get a lot of warning when you're no longer going to be at full employment. Right? Things tend to deteriorate pretty rapidly. Look at the 2001 recession. Late 2000, they were done hiking with a bias towards going again. And by January, there were emergency cutting. And you got 475 basis points of cuts that year. The second thing is there are cracks, right? Look at the New York Fed's household debt and delinquency data this quarter we just got a couple days ago. Consumer delinquencies that are ticking higher for credit cards, for auto loans. You look at the labor market. Yeah, headline job growth pretty good, but take a look at the quit rate. That's a really cyclical indicator. Quit rate high, people feel confident, they're quitting their jobs, getting, pay raises elsewhere. Quit rate has plunged over the past couple years and is already a little below where it was in 2019, which tells me, yeah, headline job growth is strong, but you're slowly but surely underneath the surface here seeing some slowdown.
Michael, what do you think would surprise the consensus more? An upside surprise to inflation over the next 6 months or a downside surprise to growth?
I think a downside surprise to growth at this point, which is a lot different from where we were a year ago, where I kind of look across the street and it's become so much more consensus to be soft landing, growth of 2% this year, whereas I think the past few months have kind of gotten some inflation expectations across the street a little more ratcheted up. So I think both would surprise, but I think the growth outlook, you see it even in asset prices, right, has gotten a lot more placid relative to the inflation.